Hi. Is everyone good? So we're about to start shortly. So I don't know if everyone can come in and sit down. So I'll explain. Yeah. So I'll explain what we're going to do, and then we will do a little bit of an exercise. We'll have someone talk, and then we'll do more of an exercise. So I don't know. I think I want everyone in because we need to break ourselves into groups ish. Okay. So like I said, this session is for the mathematically challenged. And as someone that is mathematically challenged, I can say that with my full chest. We're going to have a session on basically learning financial statements because it's important. It will be important to you if you are an entrepreneur. You might already be familiar with it if you studied accounting. It's important to you as an investor because sometimes the company can say things on their earnings call. An analyst might write about it a different way, but if you can look at the financial statement, what the company is actually doing, there is some value that you can derive as an investor. However, it's a bit iffy if you're not familiar with it at all, but it's simple. So what I'm going to do now in the next 1 minute, I'm just going to ask as everybody in person to sort of pick a number, and I want you to remember that number. It's very important because at the end of the next speaker's session, we're going to break into groups, and then each group is going to have their own financial statement, and they are going to have to come out and tell us the analysis they did on that statement, and the winning group will win a prize. It's not the 100,000 naira prize, but there will be prizes for the winning groups. So I'm going to start from here, and I'd just like you to pick a number from 1 to 9, basically the number after that. So if you don't mind, so 1, 6, no, 1. 1, yes. No, you're 9. So 1 to 9, so you're 1, okay? 7, 8, 1, 2. No, you're 1. No, it's fine. You're 1. 7, 8, 9, and you'll be 1, and you'll be 2. Okay, so it's very important that everyone remembers their numbers. You might want to write it down. Just write it down somewhere so that you don't forget your number. But please welcome with me my boss, the person that pays my salary, the COO and co-founder of Bamboo, Yanmo Omorogbe, to take us on her session.
Hi everyone, good what time is this? Afternoon. How's everyone doing? I guess thank you all so much for coming out on a Saturday morning, afternoon. I hope you guys are learning and finding it useful and interesting. And hello to the virtual audience. That's already one key learning for us. We're going to figure out a way to make it more interactive for the virtual audience next time. I hope you guys are having fun, and thank you so much for dialing in. Okay, before we get started, and it'll be good if we also get participation from virtual audience. I'll be like looking at notes on my phone as well sometimes. Is how many people here feel confident and comfortable and like, oh, I already know, like I can do this class myself. Like I can tell people how to understand. Okay, or more like I'm, pretty versed and I feel reasonably good at understanding financial statements and all of that. Show of hands. Oh, okay, not many people. Okay, how many people feel like financial statements? I have no clue. Please start from scratch, from the very beginning. Okay, I just wanted a sort of an idea of where we were as a room, so that tells me how like in detail or not I need to go. So I guess I'll say bear with me to all the people that fully understand because we're gonna start from the beginning, and hopefully this is good for everyone. Um, so we'll start with. Give me 1 second. Um, okay. So we keep going. So there's three statements when people talk about, oh, read, you hear people say, oh, reading the financials, or do you know your financials? And I'm going to talk about it just for context, in the context of stock investing, because that's why we're here. But this is valuable to anyone. If you run a business, if you're thinking about investing, even a private business, if someone comes to and tell you, I want money for this business, this helps you evaluate any sort of business, your business or someone else's business, and we'll think about from the view of an investor. There's three financial statements. Most people think about the income statement when they think of financials, and that's the statement that has, they also call it the P&L or profit and loss statement. Also, we'll share the slides after, so don't worry, don't stress about that. And the income statements help you see how the company is doing in a set financial period. So that's also important to note. If it's for the year, you'll know how much revenue they made in the years, how they made money, and how they spent money. And then you're able to assess, is this company profitable? The other statement that people talk about is the balance sheet, or the statement of financial position. And that literally tells you, where the company's financials at, again, at a specific point in time. So that's two things to note. An income statement is going to usually give you a view over a period. So it'll be like, this is how much you made over this year, or this is how much, we've spent over a year. But a balance sheet shows you the financial position at a set point in time. So if you're viewing my balance sheet today, it will be telling you how much I own, what I own, my assets, what I owe, my liabilities, and the amount invested by my shareholders, the equity at a single point in time. So that's today. So if I show you a balance sheet today, tomorrow the balance sheet can change and you can hold me. It's worth bearing in mind. So think about that when you're investing. And finally, the cash flow statement is the third one that helps supplement. And cash flow statements show how companies' cash move in over a time period again, and what was generated, what has been spent. So again, this shows you how cash is moving around, and you're able to understand what the company is spending money on, and what the company is where the company is making its money. Again, that's important because on income statements sometimes you'll see, I mean, this probably happens if anyone runs a business here, where someone owes you money, right? So let's say you've done a contract, you've done the job or whatever, and you're going to make 1 million naira. Use easy numbers. You will be able to put that on your income statement as revenue, that 1 million, even if they haven't yet sent you the money, right? Because you know that the money is coming. But the cash flow statement, but then you'll now realize sometimes you can be looking at your revenue and like, they should make 1 million naira, but if you check your bank, there's no money in the bank. And that's where the cash flow statement comes in. It actually shows how the money is moving around. So let's quickly dive into the three statements very, very quickly. The income statement usually, like I said, so it contains things like revenue, expenses, cost of goods sold, all the way down to net income, which in the context of stock investing, they call earnings. So when you hear people talk about an earnings call, is basically they're taking you through their financial statements and they're telling you how they made money that year, and usually includes an important ratio called the earnings per share. Then we have the balance sheet, a really important equation for like everything to do with accounting is that your assets equals to your liabilities plus equity. That's the essential balance sheet equation. So if you have any accountants friends, or you've ever seen them looking crazy at certain periods and they're saying their balance sheet isn't balancing, that's what they mean. Their assets are not equaling their liabilities and equity. And that makes common sense. If you own something, it has to have come from somewhere. Either you borrowed the money to get it, or you investors, or you earn the money to make it. So assets refer to anything with economic value that you expect to gain from in the future, right? So that's important to realize that assets can be stuff like cash. That one is very, very obvious. It can be stuff like buildings that are less liquid, also quite obvious. But assets are also things that you haven't yet realized value from today, but you think you're going to realize value from tomorrow. So, a really random example is I recently had to pay for something today that I'm going to use in 3 months. That's an asset because I now already hold this value of something and I'll get it in 3 months. So when you prepay things, or when you have pay for something in bulk at the start of the year and you'll be spent over the year, that's an asset, store of value. Liabilities refer to money a company owes. Again, it's not just money that you owe, but value that you're expecting to give out, right? So um, payroll is a liability. Taxes are usually a liability, even if they're not yet due. You know that you're going to have to pay it out. So it's important when you look at a business to look at their assets, look at their liabilities. Are they just, and look at them in context of each other? Are they, yes, they might be growing and all, but are they just acquiring debts at an unstable rate? Can they actually afford this? And then finally, equity. Equity is the net worth of the company. And that's, if you're investing, that's really what you as a shareholder has, which is, but what is left if all assets are sold and you've paid off all your liabilities, what's left for you? And especially when we're thinking about big public companies, it's important to look at, because that helps you understand what comes back to you, an investor. Could be in form of dividends, could be whether they do a lot of share buybacks or share repurchases, and how much money is also left to grow the business, right? Are they sending out a lot? It's even important if you're thinking about private company investing, if you're thinking about investing in your friends and family's business, to really look at their balance sheets and check whether the money you're giving them, are they using to grow their business, or are they just dashing money to the founders and CEOs? It's really important. And finally, the cash flow statements. Um, hello? Yeah, okay. The cash flow statements, again, like mentioned, they just tell you how companies' cash moves and what it was spent on. The cash flow statements have three sections. So they'll have cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Like I mentioned earlier, it's important to remember that cash flow does not equals profits, because cash flow is cash that actually comes in and out, while profit is revenue versus expenses. So you might have made money, but again, like I said, the cash hasn't come out yet. In the same way, you might have spent money, but you are owing, so you haven't taken out the cash yet. So it's important to look at companies' cash flows in the business. Just quickly, we'll just run through what the three different things mean. Cash flow from operating activity is exactly what it sounds like, which is the cash flow they make from the general operating of the business. So the day-to-day running of the business, that so like revenue and cost. So if you remember the income statement, right, at the end you had the earnings that would come up right at the top of your cash flow from operating activities, right, and then you start doing a lot of really complex math that we don't need to go over right now. Cash flow from investing activities is cash flow related to investing in things for the business. Again, most of these are what they sound like, and there is a typo in this which we need to fix, because one of those should be financing activities. I will send you a correct one. I just noticed that. But yeah, cash flow from investing activities is cash flow from um, buying and selling assets into the long-term future of the company. So if you remember when we were talking about the balance sheet, we spoke about assets as things that can give you, that have some value and resources. Any cash you spend to acquire an asset is an investment in the future of the company. And again, any cash you get from an asset will show up in cash from investing activities, because that's money that has actually come from something that is not necessarily your day-to-day operations. So if you use your own life to think about it, you can think of, let's say, if you have a 9 to 5, your salary is your money that comes in your operating activities, and then investing activities would be, let's say, when you invest on Bamboo and you have your stock and they pay you dividends, that'll go into. Does that make some sort of sense? That's like investing activities. And finally, that should say cash flow from financing activities, and that is cash flow from debt and equity financing. So if you went to borrow money from a bank, or you borrowed money, that will go in there, the debt as you're repaying the debt. If you got some equity funding, or you received some dividend, you paid out dividend, the company paid out dividends, that will go in cash flow from financing activities. Um, okay, so we I run through that. Is that pretty clear? Like pretty overall? Okay. So what we're going to do now is that we're going to quickly look at Meta's one second, at Meta's financial statements, or I would say income statements, and we'll try and see what is interesting, and see, and at the end we'll try and do a quick analysis of today, would you invest in Meta or not. So to actually make this fun and fair, I haven't looked at the financial statements before either. So we'll all be looking at it together for the first time. But I mean, Meta is one of my personal favorite companies in the whole world. So that's why I chose it. Someone had a quick question before we start. Sorry. Sorry, hold on.
Thank you. I just wanted to ask if these statements, the cash flow, income, like, do they have well-defined structures, like when you're analyzing them, or like are there like how do I put it? Like in my head, I'm trying to imagine like maybe different columns of different things. Do they are the structures well-defined, or can any company just decide how they are going to show their statements?
Um, so there's like a pretty standard ways most things are defined. I'll talk about it when we go through these statements. But the income statement, the first line item is revenue. You start from there. Then you take out, your cost of goods, or the money that is spent in earning the revenue. It's usually called cost of goods sold. And then you have you have your operating profit, and then you um, keep going, and like your operating expenses, and then so you had your gross profit up there. Sorry, my bad. And then operating expenses, and then you take that out, and then there's other stuff that goes after. I don't want to like get into too much detail, but essentially there's pretty well defined structures for each of the statements. That's like industry standards. Beyond that, when you're dealing with public companies, so like listed companies on exchanges and across the world, there's two accounting standards that mostly widely used. US uses GAAP. It's called, General American Accounting Principles, I believe, and the rest of the world uses IFRS. Right. Again, you don't need to go into that much detail unless you want to like become an accountant and anything. But we'll go through a statement now, and you'll just see it's pretty relatively easy to go through. So yeah, Meta, they're on Facebook. We'll go through quickly the Q3 2023 financial statements. I'm just looking at time, so I know exactly how much time I have. It's 2. So this is where Meta was at the start of 2023. So if you're looking for big company financial statements, you can just Google it. Like if you Google, and they'll give you the latest one for the time period. Public companies release reports every quarter, and they sort of come around a month after the end of the quarter. So somewhere around the end of January, early February, you'll see a report for the whole year before, and then in April you'll see a Q1 one, and ongoing like that. It's actually quite important to listen to know when earnings are happening, because that's when you hear some random stock price movements happening, it's usually because the companies have now come out to say, this is what's happened. If you remember from what Bill Mann said, in between we're all just making predictions. We think this company is good, we think this is going on, but then every quarter they come and say, this is what really happened, and then we'll all see, did they do better, or did they do worse than they thought? And because we're humans and we panic, if they did better, the price will go up because more people will be buying. If they did worse, the price will go down because more people will start selling. But again, to remind ourselves that, especially when you're investing long term, sometimes minor changes don't make a big difference. So we're going to talk about Facebook. Facebook, as at the end of September 2023, so this last quarter, they reported to us that every single day, 3.14 billion people on average use a Facebook app, which is kind of crazy. And they told us that increased 7% year on year. Monthly is about 3.96 billion, which increased again. So when you look at financial statements, there's usually a bit at the beginning where the company gives an overview. So they call it either highlights or like the CEO just talks, etc. One thing to note is they always start the conversations with a positive outlook. So that's what makes your brain think everything is going well. But yeah, Facebook. So their users increased, their revenue increased by 23%. So this time last year, they were making that much money, and their costs decreased by 7%, and their headcounts decreased by 24%. And what is really, really interesting is that between over the past year, if you invested in Facebook just at the end of September 2022, you would have bought in at a $93 stock price. And at the end of September this year, the stock had risen by over 3x to $300 in a short period of time. And if anyone remembers the news this time last year, all the headlines were telling us about Mark Zuckerberg had lost billions of dollars and he was going to be poor and the metaverse was going to send him to bankruptcy. But that did not happen. So let's look at their financial statements. Income statements. So someone was asking about structure. This is what most company income statements look like. They're not like super detailed. They're just really, really basic. They're especially because like on a quarterly earnings call, they're not trying to like overload. So one big thing about public companies, particularly in the US, is there's a lot of regulation around how they have to report. So part of that is that they need to be quite simple and quite clear, because obviously, as you can imagine, they can find ways to make things so clear you'll not get confused, but they have to be very, very simple. So we look at Facebook, and quite regularly they usually contain comparisons, so you can see what happened this time last year versus this time, what's happening today. So I'm going to move back a little bit. So it starts with revenue. So Facebook, so remember guys, the end of this exercise, I'm going to take about 5 minutes, is would we invest in Facebook today or not? Right? So Facebook made $34 billion in the past 3 months, right? And over the past year, and versus last year when they only made 27, so that's good. Yeah. If we take notes so that we'll remember. So they've made money, they've made more money than they made last year, and they seem to be making money overall. Their cost of revenue, sometimes that's called cost of goods sold, is about $6 billion in past quarter. So that's quite good. That shows you that their cost of revenue is much lower than their revenue. So we know that that's good. They're not spending a ridiculous amount of money to make money. That's good. R&D is about $9.2 billion. If you look, it's a little more, but it's roughly the same. So I'm just going to put this down there. It's roughly the same as last year, roughly, right? Not much has changed there. So that sort of tells you that they're doing similar kinds of R&D, right? It's not like they haven't spent a lot more, they haven't spent a lot less. Nothing dramatic seems to be happening there. Marketing and sales, they've dropped marketing costs by quite a bit, especially because these numbers are in billions of dollars, so they're spending like a bit less. And like general costs have also dropped. So their total costs are 20 billion. Remember, their revenue is 34 billion, so we can be like, okay, phew, at least the company is profitable from an operating point of view. They're not throwing money out, they're not like blowing cash. And even after they pay taxes, everything, we see that their net income is positive. So you can immediately say that Facebook is profitable, which is good, bad, depends on who you ask. But usually good, especially right now. And then earnings per share just tells you that for every shareholder in the company, this is how much they made. So they made about $4.5 per share. So overall, that's good. The company is making money for all their common shares outstanding. That's fantastic. This is what most income statements look like if you Google online. So from our Facebook income statements, we can say Facebook is profitable. They're making money. Not much has changed about the research and development that they've done over the past year. So it's still probably a very similar business over there. Then we look at the balance sheet quickly. This is what a balance sheet looks like. I wanted to just show you long, but it's hard to see. So it'll start with, no, don't worry. Don't worry. Can you zoom out, please? Yeah, so it'll start with assets up top, then liabilities and stockholders' equity. And if you remember, I said assets equals liabilities plus equity. So this is everything. So this number always equals that number, right? So if you get to the next slide. So I just, so this, yeah, so I zoomed in so we can actually see. And what do we see is that one thing that stands out is over the year, Facebook started accumulating cash in the bank. This ended December 2022 with $14 billion, and they ended September 2023 with $37 billion. So they've accumulated roughly about $20 billion in, yeah, so that's always that they're hoarding cash. And that leaves you to be like, why? But cash is great. Cash is king. Cash gives you options. Marketable securities just means security. Marketable, when you see marketable in like accounting, a lot of the time, it just means something that can be sold relatively quickly, right? So, think about, so again, someone's asking about structure. Assets are usually defined, inputs in current versus non-current, and basically current means something like cash, like it's easy to sell, you can liquidate it, so it's an asset you look at, versus non-current. That's important to note, because if you have a lot of short-term liabilities and your assets look plenty, but all the assets you can't sell it, that one can help you. So it's just important to think about it like that. But yeah, so Facebook, they've been accumulating cash. They've also, their marketable security is relatively similar, so they don't even seem to be investing the cash even short term. Accounts receivable, generally similar. Accounts receivable is what their customers are basically owing them, or people are owing them. And prepaid expenses, etc. So they're not changing a lot about their current assets. Non-marketable, again, is just, I think that's like investments that are harder to sell, less liquid. Property, plants and equipment. There's just a bunch of other stuff. And you see that their total assets versus this year versus end of last year changed from $216 billion to from $185 billion to 216. And very, very quickly, you can quickly see that the key drivers of that were they increased cash a lot, and they spent some money buying property and equipment, which is interesting to think about. And next, quickly, I'll do this quickly. Liabilities, if you run through it very quickly. So one thing sometimes, if you don't want to go into too much detail, all the time, is just first of all checking the total number. First of all, in liabilities, we see that this is versus end of year. Their liabilities increased slightly, right? Because we went from, we're at 73 at the end of September 2023. At the end of September 2023. And so we see what made that happen very, very quickly is they accrued quite a few expenses. That was the key thing. And other current liabilities. And that just means that stuff that they hadn't yet paid off, right? That's little stuff that just keeps adding up overall. But nothing seems to be hugely dramatic there. We can see that they have more assets than liabilities right now. And then equity, and that's what matters to you. Common stock and paid-in capital and total shareholders' equity increased versus end of last year. Overall, I mean, that's the key summary. So they got some more money in, and they raised some more money, and you see that here. Because common stock and paid-in capital increased. Everything else is relatively similar, and they got some retained earnings. When you see, that means that it's over a quarter, so they don't pay dividends in Q3, so there's no news there on the dividend side. So finally, very quickly, we'll go over the cash flow statements. Very, very quickly. Again, this is what they usually look like. They're big and hard to read. But if we zoom in to, next slide, please. Cash flows from operating activities. If you remember, like I said, net income starts from the income statement. Net income goes at the top. And then they start adjusting net income for all the things in income statement that weren't cash. So if you'd, put some revenue in there that you hadn't gotten, you'd adjust it. There's stuff like depreciation in the income statement that is not a cash thing. It just means that the value of something starts to reduce. So they adjust stuff a little. If you do some share-based compensation, That means you give out equity to your shareholders. You would have classified as an expense, but that really wasn't any cash. You just give out some stock. So you just start adjusting for cash. And by the end, the key thing we realize is that net cash is also positive for Facebook. About $20 billion in Q3 2022. So that means more cash came in than came out. That's the simplest way to look at it from their operating activities. So yay for them. Next, please. Investing as well, no, which is usually the case. Net cash from investing activities was lower, so they spent more money on investing in things than they received in the investments. And same thing from financing in this year. They spent more money out. They sent more money out than they received in this quarter. But that's different from last quarter, which seems to be an anomaly because over the year they generally seem to spend more money out, and that's because they've been doing share repurchases or they've been paying taxes. So that's two things to note. There's other stuff in that they also have, because they're such a multinational business, they're affected by exchange rates. But overall, at the end of the period, you can see that their cash in total is around, they have about $40 billion, $37.9 billion, which is up from last quarter. It seems to up from the same quarter last year in total, which is an important thing. So I guess, would we buy Facebook today or Meta today? Who says no? Tell us why. Pardon? Why are they keeping cash? Okay, that's just. Are you also saying no? Can you like? Hold on. Okay, so she's no. You can give it to the gentleman in the back in blue. Where is it? No, it's because I'm saying that. So she asked that why are they keeping cash? That and an investment, something looks too good to be true. Maybe it is.
Okay, hello. I'm
Hi.
Henry.
Hi. Good afternoon.
So, I agree with her. Why are they trying to keep cash? And then number two, I would need more information.
What kind of information do you think you'll need?
Okay, so they are comparing Q3 of this year with Q3 of last year.
Yes.
I prefer maybe they compare Q3 of this year with Q2 of this year. I would like to see Q2 of this year, so I
Oh.
can know if they are
Okay, that's
yeah,
interesting. So what?
cumulatively profitable or
So
just
that
for
is
that.
usually, if you go back to the income statements, please can you go all the way back up? I'm showing something. So what most financial statements do is they do this quarter versus same quarter last year, and then they do the full year to date versus full year to date last year. The reason that is because some stuff, there's seasonal changes that happen in every industry, whereby, for example, over let's say Christmas, people have very different investing activities over Q4 than they do, at the start of the year. And it's actually across the world, across various industries. So it's important for us to notice those changes. Does that make sense? But then what they do, so they do 3 months, so Q3 versus Q3 last year, and then they do year to date this quarter versus year to date last year. So you can sort of also compare that. That's one thing to note. Your point about why they're keeping cash, a lot of companies keep cash. If you check Apple's, you'll probably be stunned at the amount of cash Apple keeps. And that's usually because they're either watching to invest in terms of like trying to make investments or trying to figure out R&D. And just because cash literally just gives you options in terms of trying to see what's going to happen. So unless a company isn't growing, keeping cash in and of itself is not necessarily a bad thing because unless they're not growing for a long period, because a lot of cash is actually a good signal that there's a lot of room for them to grow because they can avoid wahala, if that makes sense. Okay, very very quickly, I'm just going to just go all the way down very quickly. This is done. This is going to be in the slide, so I'll share it with you. But there's just all the people talk about financial ratios, and you can use the financial statements to calculate financial ratios. So I've left these in the slides. We're not necessarily going to go over them, but you can look at them just so that if when people are talking. But if you go to the next slide, the one ratio I will tell everyone to look at is the price to earnings ratio, and it's just literally how much is the price per share of a stock, so current stock price versus what's the earnings per share. Remember, the earnings per share is in the thing, and it's usually how people. It gives some insights into whether people or generally think the stock is overvalued or undervalued. In that a high PE ratio can imply that people expect in the future that the earnings are going to grow in the future versus, so that can tell you that it's undervalued, right? Because people think in the future it's going to get even higher. But it's important to compare any ratios in comparison to other people in their industry. So don't compare tech industry ratios to, healthcare industry, for example, because they move differently, or the fashion industry. Compare apples to apples.